Welcome. This is KYC, a show designed to give regular investors powerful, actionable insights into the fundamentals of a single NSE-listed company every day. Today, we're looking at CSB Bank, and I have with me my colleague Harsh Sata to also help us, well, get to know more about this particular bank. But I'm going to tell you about a little bit about the history. It was incorporated in 1920, and this is one of the oldest private sector banks in Kerala at the moment. In fact, it started off back in the year of 1969. It became a scheduled bank in about 1972. It ventured into Mumbai as well. And since then, at the moment, it operates about 108 branches across India, and it does have 779 ATMs nationwide as well. Just like many others, what often happens is that you usually have a little bit of a takeover, at least especially when it comes to banks of the size of CSB Bank. And this particular bank is of no exception in this case, particularly because we did have Fairfax, in fact, take over CSB Bank back in 2018. But let's get in Harsh to tell us a little bit more about that and give us perspective on whether or not things have changed since then, Harsh.
Well, yeah, plenty of changes. In fact, Agam, this was a PSU bank prior to Fairfax taking over, and in 2018, Fairfax took over at around 140 rupees a share. Currently, the stock price is between 290 and 310 or 320. And therefore, the kind of band it's trading in does not necessarily mean Fairfax has made a very good return on this as of today. And Fairfax bought around 51% stake in the bank back then, has been told to dilute down to 26% over a 15-year period. So they have time till 2033 to dilute down to a 26%, which is typically the level which RBI allows promoter holdings within banks. And therefore, they'll have to dilute down. Currently, they hold around 40%, and they held around 49% at the start of this financial year, and they diluted down another 9% by selling to Amansa. So Amansa Capital is now also a shareholder. So you've got two very interesting shareholders, more long-term in nature, who've come in and now currently hold the bank. Of course, that'll come as part of the shareholding. Lots of management changes and lots of changes with regard to the way in which they are doing their business. They did gold loans initially, and now gold loans are a large chunk of the portfolio. They're running down the old book, and they're also building on other verticals within the bank. SME is one of them, which they're going to start to build. That could be a growth trigger as well. But that's how they're going about. The management change now at the end of Q3. Management guidance is suggesting that now management changes are complete. They've got the entire management changed fully as per their requirements, and now they'll focus on execution.
Absolutely.
That's largely the...
So a couple of crucial factors here. Firstly, the big takeover followed by management changes, but you do have two very marquee investors invested at this point in time. The overhang with respect to the management changes is now behind us, but all the way through 2033, if I'm not mistaken, is where you're going to see further dilution in the promoter holding, which currently stands at around 40%, but they have to bring it down to 26%. So that perhaps will be a slight overhang, but because there is a long period over which they can actually bring this shareholding down, it may not be too much of a challenge. But as usual, what we tend to do is we talk about the various parameters that would include the balance sheet, the income statement, operational metrics, along with the asset quality of every bank that we take up on KYC. And looking beyond, we also talk about shareholding, the valuation picture, street credentials, as well as street coverage at this point in time. We're gonna, maybe change things up a bit, and we're going to start by taking a look at the balance sheet first. So, Harsh, why don't you come in on that one?
Well, just to try and understand how the bank has grown, especially since 2018, but more so since 2021, because maybe more stability from 2021, and generally we look at the 3-year metrics when we're giving perspective. So 14,000 crore was the size of the loan book in 2021, FY21 end. In FY24 end, it was sitting at 24,500 crore. It's a 19% odd compounded growth. Small base, and therefore the growth not exactly something that stands out, because generally some of the smaller companies like an Equitas are growing at nearly 30%, and therefore that growth number not really standing out. But this one really standing out, gold loans. 5,000 crore book size, currently at 11,800 crore, and incrementally 6,500 odd crore added only in gold loans out of the 10,000 crore book size which the book has gone up by in the last 3 years. So you've just had a large component, 65% of the book, incremental book, now comprising of gold loans, which is sizable. So their growth has largely come from gold. Deposit growth has been at 16%, slightly on the lower side versus advances, and therefore your LDR is a bit stretched currently. You're seeing a CASA growth of just 9%. What are they going to do on CASA is the other big question. But it's otherwise a very, very neutral kind of numbers that you're seeing here, given that the size is small and some of the metrics don't really show that kind of growth clip that a small bank should.
All right. So that's as far as your balance sheet is concerned. So some concerns there out there, and which is why we're not necessarily, completely positive. We're going to go for a neutral, as Harsh explained. We're also going to be neutral on its income statement, and I'll tell you why. Because at the moment, we're looking at a net interest income growth of around 16% over the last 3 years, CAGR basis. And your operating profit has risen 8%. This is also CAGR over the last 3 years. Your profitability, your overall profitability is up around 38%. But if you leave your overall profitability aside, provisioning has come off quite a bit. But I reckon that provisioning would be a function of the various changes and the various outlook from time to time as far as the bank is concerned. So I won't consider that as much as your net interest income and your operating profit, which is all right, considering the size of the bank at the moment. Well, the expectation would have been faster, and not necessarily at this rate at which you're seeing 16% in top line and your 8% in operating profit, which is why we're going to go with a neutral rating here as well. So largely, neutral stands for the two of the most important financial statements for this particular bank. But let's talk about operational metrics, because that's where you will have a little bit more of an understanding about how the bank stands. So Harsh, what can you tell us about that?
Well, yeah, so let's talk about that. Very interesting as always, operational metrics. Let's talk about loan yields. You've seen loan yields over the last 3 years largely be flattish when you're looking at it. And look at that number, 10.97 in FY21, currently sitting at around 11.1%. Really, when you're looking at the repo going up from that 4% mark in FY21 to the current 6.5%, that is not reflecting here in the loan yield trajectory. So probably they're doing lower risk loans. Cost of deposits have gone up very, very sharply. I believe that 4.11 number is not right. It's a 6.19% number.
Yeah.
And therefore, from 5.1%, it's gone to 6.2% in 3 years. So your cost of deposits have really, really risen. And let's talk about margins. 4.81, 5.1 and 4.11. Margins have really compressed by nearly 1% in just the last 3 quarters, which is not good at all. Just shows that the bank is under pressure with regard to where deposits is concerned. And of course, we'll get more perspective on this one as well. Cost to income. Look at the way it's gone up. It was at 50.5%, currently at 63%. That's the other thing which is keeping a lid on operating profit.
Right.
And you look at your ROA metrics at 1.2% in FY21, it's steadily improved to 1.5%. But we're ignoring FY22 and FY23. When you're looking at FY23, the ROA was 2% plus. So it's come off quite sharply after that. And that's probably the better metric to look at it.
Right.
And therefore, really unimpressive set when it comes to operational metrics.
Right, so cost of deposits, margins, as well as cost to income, and of course return on assets. If you just consider FY20 to 23 problematic, which is why, as far as operational metrics are concerned, well, Harsh is going to give it a thumbs down. I'd agree with it as well. We'll talk about asset quality just a tad bit as well. We are seeing a little bit of an improvement there. There's no doubt about it. Back in FY21, we had your gross NPA ratio, which stood at around 2.7%. It's come down all the way to 1.5% in, well, FY24. A little bit of an inch up by the end of the third quarter. But again, we'll just wait and watch. As long as there's an improvement Even if you look at this number on an absolute basis and compare it to some of the other peers, this particular number doesn't look very, very big. Also, it's the same for net NPA ratios too. 1.2% back in FY22, pardon me, FY21. Well, coming off all the way to about 0.5% in FY24, a little bit of a move up again in the third quarter. I reckon that the third quarter earnings moving on, pardon me, the fourth quarter earnings will also give you a better idea about how the year ends. But at the moment, we're still going to give it a thumbs up because over the course of the last few years, they have certainly made an improvement there. Moving on, I'm also going to talk about the shareholding, and maybe Harsh can come in on that. Of course, we've addressed quite a bit of that shareholding bit, but at the moment, as we have mentioned earlier, 49.7%, promoter holding comes down to 40% in this particular financial year so far, and this is slotted to move below the mark of 26% by FY23. FII holding has increased substantially from the start of the financial year till now. So that stands at around 12.8% from 4.9%. And we have also seen an increase in your DII holding in this particular bank. Again, a considerable jump to 17% at the moment versus 11.6%. And because of that fact, because of the fact that institutions are buying into the company and are comfortable, even though, the overhang of the promoter holding coming down, yes, to a certain extent, the institutional holding going up will, of course, will be one of the reasons too. But overall, the increase in institutional holding is much more than the decline in the promoter shareholding that we've seen, which means that we've seen a little bit of an increase in institutional holding, which is why we're going to give this one a thumbs up as well. But is there anything else that we need to add here in this case?
No, I believe, as I did mention, 9% diluted by promoter, and Amansa has taken over that 9% stake. So it's reflecting in the shareholding.
Absolutely. And we do know that Amansa is one of those longer-term plays. Akash Prakash, if I'm not mistaken, he leads the funds, and it is of course usually it's taken as a positive. But Harsh, how valuations looking at the moment?
Yeah, valuations. This is where it starts to get really interesting, Agam. So you look at the way in which book value has moved. It was at 117 rupees per share in FY21. It's moved up to 209 rupees per share in FY24, and currently sitting at 236 rupees. Just look at that increase. The book value is going up by nearly 15% every year, compounded annually. That's a large increase for any bank. Of course, the size of the bank, very, very crucial, but that's a very, very large increase, and that's something I'll have my eye out on. And therefore, you look at valuations. Even though today at 240 versus 300, the price to book looks slightly expensive. When you're looking at it on a one-year forward basis, and 1.1 times, wish to caveat, is the math that we have done for the next 12-month earnings, basis the last 12-month earnings. And therefore, you're looking at a price to book of roughly 1.1 times versus some of the others. You look at DCB, you look at AU Small, you look at City Union, DCB being the exception. But you look at AU Small and City Union, slightly more pricier than a CSB Bank. This is where it starts to get a little interesting, but at the same time at par. And therefore, what we'll do is we'll give this one also a neutral for the moment, because you'll want to see how it performs over the next 12 months or thereabouts. But Agam, street cred.
Right. So in terms of the way the stock has panned out, it seems like it was so. Of course, we're seeing a decline here on a last 12-month basis. So it's a decline of around 19%. It hasn't exactly been able to, move in tandem with even the broader market indices. So there's been a little bit of an underperformance there. I'm not going to consider the last 1 month as much because it's just been a tough market for a lot of these companies in the broader markets in general. 6 months as well, it's seen a decline around 12%, but a lot of that has come in October, November, December. That's when the decline began. So I'd reckon even if you consider the 1 year movement, it's a decline of around 19%. Underperforming the benchmark indices, the broader market indices specifically. So it's going to be a thumbs down there. What about street coverage, Harsh?
Well, just 6 analysts cover it. All 6 have a buy rating. A 32% upside is the average upside that analysts are seeing over the next 12 months. So 34%, I beg your pardon. This is as per Bloomberg estimates, and therefore quite constructive, the analyst community on this one.
Okay, so we have the management standing by, but before we go across to the management, let's add up all our ratings and see where that particular that stands currently. Of course, these were the various metrics that we spoke about among the other set as well. Street credentials, leaving it aside, mostly neutral and thumbs up. And that gives us a total score of about 4.5 out of 8. So that's something to bear in mind. But on that note, let's get in Pralay Mondal. He's the MD and CEO of CSB Bank. Pralay, good morning, and thank you so much for joining in. My question first is to do with the growth, net interest income and profitability. If you consider the way things have moved in the last 3 years, sure, it's been volatile, but can we expect the bank to grow at a faster pace as compared to what we have been used to of late?
Good morning, Agam and Harsh, and good morning to all your viewers.
Good morning, sir.
I was going through the analysis which you're doing, very credible way of handling how the bank has performed. Having said that, our bigger picture is not really quarter to quarter or year to year at this point of time. We are rebuilding the bank from scratch, and our entire leadership team, management team is fully focused on that. And the kind of growth story and the kind of franchise build-up which you are doing based on the technology advancement or the transformation which you're doing is really the story for us on SBS 2030 vision, is what we achieve by 2030 and how we are performing vis-a-vis what we had committed to the investors. And that's why probably you're seeing that a lot of investors, whether it's DIIs or FIIs or some of these other analysts, are happy with the progress which you are making. So on such a small balance sheet, a little bit numbers here and there really is not something which you're focusing on as a leadership board or management. Having said that, on your question on growth, yes, I think this quarter we have seen that we have grown by 25%, 26% on assets and 22% on liability, which is exactly double of where the market has grown. Again, it's a small balance sheet, the percentages don't matter. And we are kind of chugging along exactly the way we had planned for the year and for the longer term vision of SBS 2030. So we are happy that we are progressing on that front. On NIM and NII, which you just talked about, yes, it has been flattish and NIM has been coming down, primarily because of two reasons. One is we have been exiting a lot of legacy portfolio which we don't like, and we are sort of end of that cycle right now. And some of them had come with larger yields, especially on the wholesale side. That's why you'll see that in the wholesale we have grown by 4% on a year-on-year basis, but core book has grown by 30%, which means the rest we have done exits, including some of the DA portfolio and some of the larger tickets, which had higher yields. And that de-risks the bank quite a bit. The other thing is we had degrown our MFI unsecured and agri portfolio, if you see product by product. And that's because we took a call around a year and a half back, almost 2 years back, that this is a segment which will go through a little bit of a wobbly kind of a scenario for the next 12 to 24 months. That's why we sort of stepped aside from that segment, which also is a high yielding segment. So we primarily operate in the 8% to 12%, 12% being where the gold loan businesses are, a little less than 12, and 8% to 10% is where the SME and the wholesale businesses are. So given that perspective, we have de-risked the bank. We are creating huge amount of building blocks. What we are doing, we are investing significantly into technology. The entire bank will have technology platform within the next 6 to 9 months, which the bank never had. And almost nothing which was there in the bank 3 years back will be there in the bank in terms of technology. So that's a big transformation. And then we will step up all our businesses, whether it is wholesale, retail, SME, and gold will continue to do well for us. I think that's the bigger picture for us at this point of time, and we are pretty much focused on that.
So completely captured the big picture. I'm going to request you for extremely short answers so that we can cover more content here and give viewers good perspective. So firstly, thank you so much for appreciating the show that we're doing. Secondly, sir, on the margin picture, 4.1% now is where your margins are at. When you were at 4.5 a couple of quarters back when we spoke, you were suggesting that some amount of the margin number will flow through the other income. Is that now complete? And where should margins stabilize at, sir? Give us visibility on that.
Yash, what is happening on the margins is because of penal interest, what I told you a few
Yes.
quarters back, is something which is no longer there in the banking ecosystem because of regulatory norms. And typically, we lost around 25 basis point on the interest income. A high single digit is what we are able to get back to the penal charges. That's why we're seeing that we have grown overall on the fees side pretty well on a quarter to quarter as well as on a year-on-year basis. But yes, I think some part is coming back. On the view on margins, I think it will remain at the similar level, maybe a little lower, because even a 4% margin is not bad in the current scenario. So we are pretty much happy anything between 4 to 4.2, and we are on that track. But we are going to focus on growth, and growth, we can sacrifice little margin for growth, which you're okay with right now.
Okay, so point taken. So will you hold at 4 or will you go below 4? Are you
See,
okay with
we
going below
can't
4?
dissect the numbers so much also because given the liquidity situations in the
Sure,
market,
sure.
it's very difficult to guess which way it is
Take your
going.
point.
So it's some of the measures which RBI has taken yesterday or day before yesterday and last 2 days. If that works out, maybe the cost of deposits will stabilize. But we have to wait and watch and see the liquidity situations. But we'll broadly be there. I mean, we don't want to split the hair on few basis points here and there.
Fair point. So 85 basis point increase in cost of deposits in the last 9 months. Is this pressure real for you? And I believe that your liability franchise in the South was strong. Is there something you're doing with regard to this thing? And is it a problem you recognize?
We always said that we are building the liability franchise, and that will be built only after our core system is in place and our entire surround system is in place. So our real work on building the liability franchise along with retail assets franchise and supply chain and everything will start only from FY 26-27 onwards once we have the entire technology in place. Right now, what we have done is we continue to do well on the fixed deposit growth. And incremental, see, we grew by 25%. Had we grown at 12%, which is the market, then we would have a much lesser cost of deposits because the incremental deposits comes at incremental cost. We also did FCY borrowing, which comes at a slightly higher from IFC and HSBC,
Right.
which is slightly higher, but that also will come down because they are SOFR linked and things like that. We also had refinance. So overall, our LCR has been 130% last quarter on a period end basis, and on an average 119. CD ratio has been 86%. So from a liquidity risk perspective, see, we're a risk averse bank. Whether it is liquidity risk or credit risk, we are doing pretty well on that. Little bit cost of funds or cost NIM pressure. It's a transient phase. We really don't think that's most important. Most important is building a risk-free business and with a sustainable compounding growth story.
Fair point. Okay. Appreciate that, sir. So with regard to NPA ratios, bit of a spike when you're looking at it over the 9-month period. Any concerns you are seeing there? And what's the ROA picture looking like? 1.5% to 1.7% is your guidance. Believe that there is downside risk to that guidance?
Let me first take the ROA part. I think 1.52 is where we were. We're slightly higher than what we did last quarter.
Yes.
I think we'll be broadly in that level till the NIM pressure subsidizes. We are able to manage the fee businesses, and operating cost matrices also are doing pretty well. So I think we'll be in that 1.5 to 1.7 range. Probably at this point of time on the lower end of that range will remain. On the overall, I think, what was the other question you had asked? NPA, right?
Spiking up
So,
a bit, is that a concern at all?
so NPA actually went down by 10 basis points on a gross basis quarter on quarter,
Yes.
and 5 basis points on Q on Q. But yes, on a year-on-year basis, if you see, it has marginally gone up. And that's primarily because of one account which slipped on the wholesale side in the beginning of the year. And right now, as you know, the entire industry has some challenges on the unsecured MFI and agri kind of businesses. Our challenge is much lesser, but still there will be certain challenges, transient challenges. I see that we'll remain in the similar kind of a range where we have, because our slippages has been 0.87%, just around 62 crores. So slippages has actually been lower than last quarter marginally. So overall, I think on the NPA side, it's a good story to tell for us at this point of time.
All right, so we leave it at that. Thank you so much for joining us and taking us through your view and now the outlook for CSB Bank. We look forward to hearing a lot more from you going ahead, sir.
Thank you, Agam. Thank you for having me.
All right, and on that note, we are at the end of this edition of Know Your Company. Lots more lined up on the other side. You're watching NDTV Profit.